on. They would like to see the meetings, and I can understand that. It's hard to listen sometimes. So we'll get started with Scordino and Ginny. They're going to discuss Prop 15 and mostly Prop 19, right? And I sent out a good article that Ginny had written yesterday. I hope you guys all received it. Did you want to go ahead, Ginny?
I was just going to say, it's okay if everybody hasn't read it, because that's what we're going to be talking about today anyway. So it's a little bit of background. So I'll let Dawn lead the discussion, and I'll just pop in as necessary.
Okay. You want me to kind of tee it up, Jenny?
Yeah, that'd be great.
Okay, well, as we know, November 3rd on the down ballot will be some other important things, and that would be Proposition 15 and Proposition 19. Both of them have to do with the 1978 version of Proposition 13. So if this starts to get a little bit confusing, I think we're going to see where our role is with our clients, our friends, by letting them know what the differences are. Both of them will have major impacts on real estate. Basically put, Proposition 15 is nicknamed the split roll because it would split residential and commercial and agricultural real estate as far as how they can be assessed for taxes. Boy, getting a ton of texts. Didn't get any until 8:30. Now they're all starting. All right. So anyway, that Prop 15 does that. I think most realtors, most people in real estate are going to see that, hey, this could bankrupt some businesses. So think about the people that own a strip shopping center or people that own a farm. They're struggling right now anyway because of the pandemic and its effects in the closing of a lot of businesses. Think about that strip shopping center that maybe has a nail salon, excuse me, a nail salon, a barber shop, and they're closed down. They're not able to get rent as normal. And now they might get their property taxes assessed and probably upwards. Okay, that's Proposition 15. The way that they wrote it, it sounds like it's commercial property owners versus school children. That's the way it looks on the ballot, because that extra money could go to school children. All right, so when you read these things, be weary of that kind of stuff. Now, let's go to Proposition 19, which is, according to the realtors, California Association of Realtors, it's a good thing, because rather than subtracting the rights of Proposition 13 with Prop 15, see, it's getting confusing, but Proposition 19 will expand what the original Prop 13 did. In fact, I think that might be a good way in explaining it. With our elevator pitch, we always refer to it as the original Prop 13. This way it doesn't get confused with 15 and 19. Okay, so what Proposition 19 does, the proposed 19, is that it will expand it so that if there's a senior citizen or somebody that's been impacted by natural disaster like the Paradise wildfires, it can they can move their existing tax base to a new property, whether they have to buy up or buy down. Now, a lot of times you're moving, this happens a lot in Fresno. Maybe senior citizens that have been living in their headliner home over by First and Ashland for 40 years, and they've got a tax base in the hundreds. Well, they want to move closer to the grandkids, and let's say they want to move to Madera or Riverstone. Let's say that you're going to move to Riverstone. Well, just because the thing's newer is going to make it more expensive. The way it is right now, they have to buy down. So if they sold that house for $250,000, they would have to buy something less than $250,000 to retain it. But they would lose it anyway because they moved across the county line. It's only good in Fresno County. So that's a weaknesses of the existing policy. You have to stay in your county, you have to buy down, and you can only do it once. So this would allow it. Proposition 19 says you can move to any county in California. You can buy up, however you will pay the new assessment on the excessive amount. So if you sold for $250,000 and you bought for $350,000, you're going to be taxed with the new taxes on the $100,000. But for the original $250,000, you move your tax base, which might be only at $150,000. So you see how this is confusing. We may have to spoon feed it. Spoon feed it to some of our clients and just say, vote no on 15, yes on 19. Now, in all of this, Jenny Toste, who's a realtor at Realty Concepts, but also is a columnist for the Fresno Bee, did a lot of research on this and wrote an article. And so how about if, Jenny, I turn it over to you, and you, because you talked to the opposition people too, the people that oppose our position. You also talked to Paul Dictos,
Right.
who is our county tax assessor, and he had some interesting comments. So I'm going to turn it over to Jenny now, if you're ready.
Sure. Yeah, I talked to Paul, and it was very interesting to hear his point of view on it, because I think a lot of people aren't thinking about how much it's going to cost to reassess buildings every 3 years. And so he's saying that he's already let the supervisors know that if this goes into effect, Prop 15, that is the role, if this goes into effect, he'll have to double his staff. And while it's going to add 1.2 trillion in assessed value onto the rolls, it'll cost at least $1 billion to implement it for the next 3 years. So that's another layer of bureaucracy and assessors and quarters that are trying to just run the numbers on having to do this every year. So it's going to have a huge cost just to implement it. And of course, all of those costs are getting passed on to the landowner. And he's saying it's actually that people haven't thought about is that it's going to have negative roll growth in small and rural communities. So I'm assuming that means it would cost more to implement than the county's actually going to take in. So it could actually cost more while it's costing the taxpayers more there. Another interesting caveat to Prop 15 is that there is a $3 million exclusion. So this means that if somebody owns $1 million property in, the assessors are going to have to go see if they own land somewhere else, anywhere in the state, to see if they meet that $3 million exclusion. So with 58 counties, you're going to have county tax assessors calling 57 other counties to try to find out what land this person owns and if they meet the $3 million exclusion. So you can imagine the nightmare for tax assessors and reporters, because they'd have to do that on every single person. There's not a state registry of all the properties that everybody owns and what the value is. So logistical nightmare on that would be insane. And his personal comment was he doesn't understand how crazy it's going to have to get to satisfy California's insatiable need for higher and more taxes. So he's just saying it's not been thought out about what it's going to cost to implement and the kind of headache it's going to cause for assessor recorders. He also said, while ag is excluded, that's only for unimproved properties. So something that really affects us here is going to be if there's any type of an improvement on the ag land. So if there's a cold storage facility, if there's processing, if there's packaging facilities, those are all going to be taxed now, reassessed every 3 years instead of being grandfathered in via Prop 13. So that could have a big impact on our local ag community. So that's some of the things from Prop 15 that we heard just from Paul and that one. Any questions or follow-up before I move on to 19? Is that make sense?
Jeannie,
Hi.
hi. In regards to cold storage, does that mean a farmer that owns his own distribution center, that owns his own cold storage, is going to be affected on the improvements of the cold storage on the increase in taxes?
It sounds like that. So if a grower had his own facility for holding that food, or if he's a walnut grower that owns his own packaging area, the cold facility, all of that will be now reassessed every 3 years.
Thank you.
Quick question. Any assessment on how many businesses we lose, both just losing the businesses and how many just get up and leave California?
I haven't seen that, but Paul did reference that it's going to drive more people out. And I've seen that in some other things. I think more with this one and the idea that with commercial properties being taxed. So there was an independent analysis. I could double check that one. I don't think I've heard the actual number, but that was the concern from one side, that this will be the will drive more people out of the state, which could then impact, the taxes again. So the projected revenue will be impacted by businesses leaving. Okay, so Prop 19 is really interesting. So that's the one I wrote. So I have a monthly column for the Bee. I used to do broadcast news, now real estate, and I do an article on finding common ground for the Fresno Bee. So normally I don't do things that are connected to our industry, but this one, even if I weren't a realtor, I'm concerned about the future of property taxes. And I don't know how many of you guys watch Yellowstone. Has anybody watched Yellowstone with Kevin Costner and his Montana Ranch? Okay, highly recommend it. Okay, Douglas does. Okay, so but the idea is that he has this 7-generation Montana ranch and everybody wants his land because it's huge. So all these different groups keep coming up with ways to drive up the surrounding property values so that his taxes go up and he can't afford it and he loses his ranch. So whether they're putting in a casino or a ski resort, the idea is, hey, if we create a new boom town right off of his property, his property taxes will go up and he can't afford it, he'll have to sell. And I'm watching this, I said to my husband, I'm like, this is patently un-American. The fact that you could own something free and clear and they can drive up property taxes and you lose that is just shocking to me. And it's like, no, you don't ever know that you just have your land. And my brother just moved to Texas and his property tax is 3% versus ours is, close to 1.25%. And so I was thinking about that because my parents thought maybe they'll buy a condo out there so they can go see the grandkids. And the idea that, you don't have income tax, but you have to pay that. So even if you're retired and you have no income coming in, you're still paying a hefty property tax. And they do have ways to reduce it. If you're disabled, it'll reduce it by the same percentage and stuff like that. But interesting idea. Now, contrast that with California, we're in a good place because our property taxes are less than 3%. But in Texas, they don't pay income tax. So here, your tax every dollar you earn. You're taxed on every dollar of real estate that you have, and then you're taxed if you buy anything with it, and you're taxed when you inherit it. So I'm like, well, there, you know, we still have quadruple taxes, but at least our property tax is lower than that. So that's kind of how I first got into Prop 19 and wanted to take a look at it just from a landowner point of view and wanting to be able to pass stuff down to my son. And so I wrote the article. The B told me they're not going to run it because I am connected to real estate. So I'll write a new article for this month. But anyways, you've seen the article that I did write for them. And the idea is that the San Jose Mercury News, their editorial board, obviously more liberal up in San Jose, is against Prop 19. And the reason why they're against Prop 19 is because they think the whole system of property taxes, as they are right now, is needs to be redone. They want a complete overhaul on it. So of course they don't want Prop 13. But as part of that, they think there's a ton of inequities and we need to balance these inequities. And they're saying, you know, it's not fair that someone might pay a fraction of what someone else on the same street is paying. And in my article, I said, yes, you might be paying a different, you know, amount. But if you're a retired person who bought your home 40 years ago for $100,000, and then you have a tech boom and someone comes in and buys it for $1 million, and they can afford $1 million and they can afford the taxes that go with $1 million, isn't that the definition of inequity to force a retired person on a fixed income to pay the same amount of tax as someone who just came in and is earning a lot of money? But we're not seeing that. So when we hear the call, so then I talked to the Yes on 19 group, and Yes on 19 obviously sponsored by CAR. And with Yes on 19, they were saying that, just lost my train of thought on that one. Oh, they're saying, you know, what we're seeing is a push from legislators to get rid of Prop 13. And so they're saying it's going to go by the wayside. They were already pushing for it to go by the wayside before COVID-19 hit. Now they have their perfect excuse of we have budget deficits, so we need to dismantle Prop 13. So that's what Yes on 19 is saying. That's what CAR is saying about this. And we're seeing that from the San Jose Mercury News. So they're saying that there is this big inequity and we have to balance it out. But they were making assumptions like, okay, this is something that protects an often wealthy person from giving their land to the next generation. And that just sticks in my craw personally, because you know, my dad came from nothing, worked his way up, became, put himself through school, became a doctor, served in the military, and now you want to call him wealthy and you're going to tax things that he leaves to me. And so one of the big things that on the other side is getting the conservatives upset about Prop 19 is closing this loophole, it's being called, about people inheriting land or property that is not their primary residence. So there was this big thing back in the LA Times about land in Malibu, about, you know, some wealthy celebrities, bought land way back when. Now they've given it to their children and they're used as rental properties. They make a ton of money off of them. They're not paying any taxes on it, a smaller amount of tax. So the idea was, let's close this loophole. Or there's trust fund heirs that have inherited all this property. They're not paying their fair share of taxes. And they're saying that there were non-California residents who are benefiting from this law. So from a conservative point of view, the Orange County Register, their editorial board wrote an article saying they don't like Prop 19 for that reason. So you have Prop 19 that's supported by CAR, and you have the liberals not liking it because of portability. They don't like the idea that you can transfer your tax base and take it with you, thinking that continues inequities. And then you have the Republicans down in Orange County saying they don't like it because it's going to tax people more. So their quote was, we're going to tax even more a highly taxed populace as it is. And they're calling it for a cynical special interest. So they don't like it because, so I guess the California firefighters were against this measure 2 years ago. And because the California firefighters came out and said, you know, this isn't fair, and according to the Orange County Register said, why is not paying your fair share of taxes stealing from everybody else. They're saying, no, you're just keeping money that's owed to you. And so this time CAR has partnered with firefighters and is going to earmark some of the increased revenue for the state for increased firefighting. So there will be a local portion that goes to support schools and local government. There will be a state portion of the increased revenue that will go toward firefighting. And because of this, the firefighters union is now on board. So some people would say that's just how you get a deal done in our legislature. Others would call it a bribe. So the OC Register and Paul Dictos call it a bribe. And they say you essentially bribed the firefighters to be on board with it. So in terms of the portability issue and San Jose Mercury not liking it, so as Don was saying, you can move up to 3 times, transfer your tax base, go anywhere in the state, and you can buy a more expensive property. So San Jose Mercury News doesn't like that because they said, oh, that takes away the whole idea of downsizing. If you are going to be increasing the amount you pay, that's not downsizing. Well, we all know it's hard to buy the same size property, especially if you bought 30 years ago, and pay less, even if it's a bigger one. So my point in the article was, okay, well, if you live in Fresno, my parents, for example, had a big house in Fresno, bought a condo in San Diego for the same price. So if you downsize or you want to move to be near the grandkids, it might cost you more money, and you're going to pay full tax on the increased amount between what you sold it for and what you buy the next property. So it's not giving you a freebie on it. You're paying that tax. You just transfer the original tax base. So San Jose Mercury News doesn't like it for portability, but says they'd love it if it included the part about closing the loophole. OC Register says we hate it because it closes the loophole, but we like it because of portability. And in CAR's position, if you look at the very end of it about, it's interesting because it does talk about how this closes the loophole, and it says that for trust fund heirs and non-California residents, and for conservatives, that's very concerning, seeing that kind of a stance come from Yes on 19 in CAR, because it's, their point of view was, if my parents have worked their whole life and saved their money and bought a bunch of rental properties, then why am I being penalized for that? Why could I lose the properties my family worked so hard to let me inherit because you're going to increase the tax rate on them? But that's the trade-off that CAR has made to try to get 19 to pass. And when I talked to Becky Warren at Yes on 19, she said, listen, I get it. She's like, I understand why conservatives will be upset about giving up any of these types of tax benefits. She is, but the reality is we're going to lose all of Prop 13. It's being accelerated by COVID. And she said, so if we don't vote to at least keep part of it, then you're going to lose it. But the other point too is that they always use this argument for it affects the wealthy. Well, it affects a lot of us that have just been working hard to save our money and invest in real estate. So for example, my parents' condo in San Diego, if they leave that to me and I don't take that over as my full-time residence and it becomes a second home, then it's going to be reassessed when it transfers to me. So whatever that value is, suddenly I'm going to be paying taxes on, let's say it goes up and it's $1 million. I have to pay tax on that. And so it makes it a lot harder for people to inherit property that way. So my point of view from a common ground is, okay, both sides are upset about it. At least we can agree that we need to protect personal property, and at least this does do that. But there are things that both sides don't like about it. So that's kind of what I found in a nutshell from those two different sides. So questions about that?
Again, I go back to what happens to the value of real estate, because part of the reason California has been a good place to purchase is because of the Prop 13 and the taxes. You take that away, it seems like you are you're shooting yourself in the foot as far as property values, and the values are going to go down, and that's going to impact the taxes anyway. So, and I go back into the whole idea of our 1031 exchanges. That's why buying in the United States is so attractive to offshores, because you have that ability to defer your taxes. You take that away, then why buy here?
Yeah. Yeah.
I would like to add something, and I know I'm not the oldest guy in the group, so there's a few others that will remember this too, and that's pre-Proposition 13, prior to 1978. I was just a young guy, but I remember my mom, who was on a fixed income, kind of juggling and struggling to make ends meet. And I remember her opening up the tax bill, and it had just skyrocketed on her. And I remember my poor mother crying that I don't know how I'm going to do this. The property taxes went way up. I remember we called the tax collector to see, what are you doing this for? Here was the explanation. At that time, the county said, well, here's our budget. We need to spend this much over here and this much over there. So to make ends meet, we need to raise our income. And that's why they bumped property tax. Once Proposition 13 came along, good budgeting had to happen. They had to say, well, this is going to be our income, so this is what we can spend. And so that's the difference. Pre-Prop 13, you had a variable expenditure, and taxes were variable to meet that. With Prop 13, it's more of a fixed income that can escalate each year, and it certainly escalates as property is transferred. I mean, gosh, your property taxes now are probably higher than most car payments, even though it's limited by Prop 13. So maybe make the analogy of a fixed rate mortgage and an adjustable rate mortgage. If you think of it like that, I think it's easier to understand what this would do to us. Thank you.
Any
And right. Well, I was going to build on Don's point that, the whole point that we tell people in real estate is, buy 30 years, it never goes up. But your property tax would be like that variable rate mortgage where it could go anywhere. So my broker's taxes can go up 8% a year in Texas, and 8% every year is a ton of money that suddenly you can't afford your home anymore. Even though you might have paid it off, your property taxes could go up that much. And it adds a level of anxiety, worrying, if you're buying in an up and coming area and it keeps growing, are you going to be priced out of that place? And then to Dave's point about, about the, forcing people to not invest in here, I did see people start to worry about that. Why would you buy a land in California if you give it to your kids and it gets reassessed and they can't afford the property tax? What's the point? It also made me think about, calling it a second home or vacation home just because you inherit it from your parents. And let's say they're retired somewhere nice, like the coast, like the mountains, and you would like to keep that in the family as, the whole family goes there. Well, you would get reassessed on the taxes as soon as it transferred there. And so the question is then, I wonder if people would race to, have their parents before they pass, sell that place in the coast, buy a nice house in Fresno or wherever, and then they could be passed down, and that could be your primary, and then you avoid, the tax transfer. Although then, because they'd have their transfer on it. So I don't know, it could create a whole bunch of weird scenarios where people are doing that, or it could force people to not want to invest in rentals in California because once you give it to your kids, it gets reassessed, versus if you can find somewhere else that has this. I mean, Texas would not be an option, so you'd have to find another place that has a similar Prop 13 rule on capping taxes unless it's sold.
Why is Harvard Jarvis taxes? Why are they against this? How does this hurt us as investors? There's a huge part here on investment, and what is it going to do to future rentals? The price of renting, the price of renting a business, a building to put your business in. All of this is affected by Prop 19. And if I move into it, if my parents die that have investment properties, if I move into one of the properties, then that property stays the same, but the others are reassessed, okay? So by allowing Prop 19 to go through, we eliminate Propositions 58 and 193 that we voted in to save these taxes. So I'm against Prop 19 the way it's written.
Mm-hmm.
And that's why I thought it was interesting to say that this proposition is very controversial, because it does affect that. I don't see Lori, who's the attorney in the group, but if your properties are in a trust, does that change things? Tom, do you know? Or John Sweeney, do you know? No, okay. So that's a good question. We'd
Carmen.
Yes, sir.
No, I'm sorry, let me expand on that. If the property is in a trust and the people or the owners of the trust pass away, any activity on 19 and 15 will not be touched at all, because it will no longer be the property of the trust. It goes out of the trust to death. So no, I can't see trust as an obstacle to prevent an increase in cost of property ownership.
Yeah, this is challenging. I was very surprised when I saw that CAR supported Prop 19, but it's one of those things where you have to weigh which is more important, and the politics involved too. People trying to make something happen on one side and finding the middle ground. No pun intended there.
Yeah, but true. Yeah, and that's the whole idea of back to Paul's question about Howard Jarvis Taxpayers Association being against it. It's because of that reason, because it gets rid of Prop 58 that people voted in about transferring those properties to family. And I don't know when this idea came around that just because somebody is hard and builds up from nothing and they can leave something to their kids, which in my opinion is the American dream, right? We're all trying to leave our kids in a better position than we were in before. We're trying to build that wealth for them. Then suddenly you're wealthy and you're not paying your fair share. Mm-hmm. And so you're right. For that reason, Howard Jarvis is against this, because it gets rid of Prop 58, and you are going to be reassessed on all of the properties that you inherit except for a primary residence. So if you leave 10 rental properties to your children when you pass and they don't occupy those will absolutely be reassessed when you transfer them. So because of that reason, for conservatives and idealists, it goes against those principles. And so for that reason, that's why the OC Register and Howard Jarvis is against those. Are saying on the other side, we get it. We don't necessarily disagree. They're just saying, try to save parts of Prop 13 before it's gone. So you have to weigh, do I want to be idealistic about this and say, nope, I'm not giving that up? And that makes sense why people would think that way. Or do you want to say, I can read the writing on the wall in California and I'm going to preserve parts of Prop 13 with this one? So it was, it didn't pass 2 years ago without this in it. And without this in it 2 years ago, that's why California firefighters were against it. It's saying, listen, people are paying an artificially low tax rate and we don't have enough money to pay for things like needed firefighters and school improvements and yada, 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 what you hear every time. And so because of that, they put this in here. That's how they got the firefighters support, and that's how they're trying to change it this year. But you have to decide if you're willing to take that trade-off or not. It's a big trade-off.
Hey, John, go ahead.
Okay. 2 years ago, what really hurt us, it wasn't so much just the firefighters against it, but when the Secretary of State wrote the analysis for the financial impact of of our proposition at the time, they put in there that it was a big cost to the taxpayers because when that senior moved, they wouldn't get the tax bump. What they did not factor in, though, is when that senior sold the old house, the new person moved in and raised that one up. But that's politics. We are in a very political state. And Secretary of State was probably told how to write that, and that's what they came up with. If you notice, even to go back to how we're in a very political state, Carr has not come out with a strong opposition to Prop 15 yet, even though they are strongly opposed, because we're kind of in detention from the governor's office. He's still upset with CAR because CAR was the last person standing on the rent control issue. And from what I understand, we're not the favored child anymore because of that. So I think they're trying to figure out how to do the political dance.
Don and the group, I've never run a state yet. I've run a lot of things, but I've never run a state like California that has, 40 million people? And it costs money to have a state with 40 million people. We got to provide health care, we got to provide education, we got to provide their ability to have a place to go to sleep at night. But the one thing that we don't want to do, our taxes increased. So we have to, right now, the state is going to be a political football because it's something that they can much easier increase taxes rather than coming up with a tax that's on its own. So basically, these masterminds or these so-called masterminds, we're going to have to come up with a way that we can, if anyone believes that the state of California right now is dealing in the surplus, I'd like to know who the hell it is, because I don't think we are. We've got 350 forest fires in this state right now. We've got a pandemic in this state right now. We've got unemployment in this state right now. Now we have homeless in this state right now. What do we want to do? Who do we want to let die? Or what do we want to do from the standpoint of coming up with an ability to let people live? Now, we don't want real estate because most of us sitting in this group today, we own our own home, and it says, it's kind of a NIMBY thing, not in my backyard. But we've got to come up with with a revenue generating tax, if you will, that we don't have right now. Or maybe it could be in the form of a consumption tax. And whatever it be, will I feel better if I pay the same amount of taxes through a consumption tax as if it was an increase in my real estate tax? Would it make me feel better and sleep better at night? I don't know, but let me tell you something, fellow members. We have to, or this state says, to come up with a way to generate the funds necessary for us to exist. And until we do, real estate is going to be a tax football.
Tom, there's two ways of looking at that. The other way is to learn how to balance a budget and not have too many people working within the government. And by shrinking the government, you're able to do that as well. So you can keep giving candy to the kid. He's going to keep grabbing it.
Well, you see, there's where you and I are different, because if there are certain states that want to get rid of a police department. Maybe what in the state of California we'd like to do is get rid of some of the California firefighters. Maybe what we'd want to do is reduce the salary of our first responders. Believe you me, I don't.
So I'll just, Tom, real quick. I'm just going to right now make sure you understand. I was not what I was suggesting was public service at all.
Money is money.
I'm on a few boards myself at the state level, with the Restaurant Association. So I see this from the same level or different level. There's a lot of bureaucracy and a lot of people getting paid maybe what they don't need to get paid, and a lot of money not being allocated correctly to begin with. So
That is
it's
true.
a catch 22. It's like, do you want to build up our mental health facilities again, which is going to essentially cost us more money, but then would it save us money with the hospitals and healthcare? I don't know.
Absolutely.
But I mean, there has to be a way of balancing this out where you're not necessarily taking more money and giving it to somebody, because that's never going to end. You have to create a system where there's a balanced budget and there's a right amount of people doing the right amount of things for the people that are paying for it. I mean, we are the people. These folks work for you, not the other way around. And we have lost that edge, and we've allowed certain groups to take on that edge. And until we decide as a group or as a people to stand up for what we know is right, which is what our ancestors gave us, they're going to keep taking. They're just kids and they're power hungry.
Yes, I see both your points, and I think there's no real good way to be on a level field right now with all these changes and when there is a need for money for the state government. But I'm pretty conservative, so I just wish there was a balance where, hey, right now with people taking their property taxes to the next home, you know, it's within a 5% range. I'd maybe like to see that increase to 15 or 20%. You know, not a great number, but something that will be helpful for seniors and free up inventory that I think we do need and allow them to move. Don, you have a question or a comment?
I just changed my virtual background because this is where I think taxes are going.
And you have a hand up. That's why I was asking.
Oh,
You know
yeah.
what? Oh, go ahead.
You know,
I'm done.
this not only affects us as investors, but it affects everybody that is involved in a rental, meaning anybody that rents for a purpose, to live, to run a business, whatever. Just for those that rent for a place to live, that's 53% of the population in California. That's 21 million people that are going to be affected by this, because if the taxes go up on a piece of property that you're renting, what am I going to do? I'm going to pass that on to you. Okay. And I can do that because it's a transfer of ownership and stuff. So I can raise the tax on it. And also I believe I can raise it because it is an increase in tax. So it's going to affect a whole lot more people out there than I think anybody really realizes if this passes.
You're right, Paul. It's actually both props would affect renters in a way that I don't think is being thought of. So with Prop 15, it affects commercial buildings, industrial buildings, so strip malls would be affected. So once the property tax goes up on the person who owns that commercial building, what are they going to do? Pass it on to the renter. So then that small business is going to be affected by having to pay higher rents. The consumer is going to be affected because they're going to have to pay higher costs for the services or the goods because of the higher rents. So it will have that trickle down effect. Just because you tax the landowner doesn't mean that no one else is going to feel it too. And that's the same thing with Prop 19. So I don't know what percentage of rental properties are going to be passed down soon, but you're right. If you know, I inherit a rental property from my parents and my costs stay the same, I can keep the rent the same. But if I inherit a property from my parents and suddenly property taxes double, guess what I'm going to do to the rent? What I have to do to the rent. Otherwise, I can't afford to keep it. So that is something that hasn't really been explored a lot by a lot of people about what that's going to do to this. Now, for Prop 19, NAACP California and also the group for Californians with disabilities, they both support Prop 19 because they think it helps with housing stability. And I think a lot of that is because of the idea of portability. So what the San Jose Mercury News kind of missed in all this is they were saying, okay, if you have a senior who wants to downsize, then they're going to be competing with first-time home buyers. So what they're missing in all this, and what we see as realtors, is that there's a housing shortage. And so we have to get people who are empty nesters and family homes out of those family homes so that another family can move in. And we need those seniors to move to an area that maybe isn't as good for families. So maybe it's an area that's more rural, it's the mountains, it's the coast where there aren't a lot of jobs, aren't a lot of schools. And that means that first time, when they move up and a family moves up into their house, then that opens one of the existing properties for a first time buyer. And so if you have portability and you're not forcing that senior to stay in the same county, then the system actually works better where, the senior can move out of the Bay Area where a family needs that home and move to Mendocino or move to Monterey or wherever where there aren't families looking to buy a first time home. So ironically, their actual argument was cyclical and coming back in itself, showing that no, actually portability would help time home buyers being able to move around. One other point, when I spoke to Paul Dictos, he did say with Prop 15 that it would cause rents to go up for business owners because those are going to be passed down to everybody in the strip mall is going to have increased rent. So that is another thing that, a lot of times we look at the money that's going to be brought in as the projection of like, oh, this will raise, 1.2 billion from Prop 15. And right now, Tom's right, the state has lost all of its surplus. They've already told Fresno State they're cutting people, the layoffs are coming across the board. And so the 1.2 billion looks really good. But I actually think it was Paul who told me, but what's the cost going to be for business who decide, I can't afford to be in California anymore, to Dave's point, and actually Prop 15 could drive a lot of those businesses out for that reason. And that's factored into the 1.2 billion that would be brought in, which is the point about we see those initial numbers, but we don't see them play all the way through. And it's going to have impacts that probably aren't being talked about or thought about right now.
Yeah, well, Don and Ginny, thank you for bringing those to our attention and expanding on them. It's really great. We as realtors, me as an investor, I think where I would stand with these propositions. I do work very hard and would like to, make sure that if I do have properties, my children don't have to be submitted to all of this, but I can see where money is needed. And it's a lot of, introspect to look into these and be aware, make people aware so that we can share this information. If we have this talk here and a lot of us maybe are not too aware of the small details, can you imagine the greater population? So that's why I appreciate this. And gosh, we can go on and talk about this indefinitely, but we'll get to Doug now, who is going to discuss what a lender is looking for when you're looking to buy commercial property. Okay.
Carmen, can I say one thing?
Yes, Paul.
The movement in Sacramento is to move elderly people into high density housing close to government transportation. That is the movement in Sacramento. So no matter what we do in trying to save things for the elderly and to move on, their goal is to put us in high density housing close to bus transportation stuff. That's their interest. That's the light at the end of their tunnel.
Right. Okay, Doug, let's see, let me unmute, there you go.
Thank you. The opportunity today, there's a lot of you on this call that probably could teach this or know all about it. So today I'm just going to do a 30,000 foot level, just an overview of kind of what they're looking for. I've got some slides or some things to kind of walk us through some stuff. If you ever have any questions, give me a call. But Roger, you should be teaching this right now, so you're the expert in the room, basically. But basically, I wanted to talk about kind of commercial and apartment lending, kind of what they're looking at When it comes to apartments, apartments are broken down to, or investment properties are broken down to 1 to 4 unit family, which is basically your residential type stuff. You guys pretty much know how to do that. They look at the borrower's income, they look at some of the rental, they minus out the expenses, and then figure it into your debt or into your debt ratio. Those are just regular Fannie, Freddie, even FHA type financing. It's when you get to the 5, and apartments are usually broken down 5 to 19 units and then 20 or more. So they look at them differently, and obviously those are broken down by sophistication and loan amounts and things like that. So if you look at these handouts, and I'm sure Carmen will send them to you if she hasn't already.
Well, I'm sharing.
But it's just some overview of kind. What's that?
Is this the right one, the apartment financing form first?
Yep, that's it. You can see apartment permanent, and we're talking permanent financing, so it's the long-term portion of it. You can see today I've thrown some generalities up there as far as what the terms are and the rates are for permanent, and you know, it's anywhere from, depending on what the first group we're talking about is basically non-recourse, pretty large loans, usually loans that are made to REITs, limited partnerships, you know, partnerships, or even corporations. These loans are anywhere from $1 million to $100 million. They're government backed usually. They're either Fannie, Freddie, or FHA. You're looking at loan sizes from $1 million to 50, and they're usually looking for 20% to 25% down. Most of these loans, because the borrowers are an entity or whatever, they are non-recourse. By that means there's no personal guarantees to individuals on them. They do offer 30-year amortizations, and they do have prepayment penalties. These are loans that they want to stay on the books for 30 years. A lot of them are sold off to Fannie, Freddie. Some can even be sold off to insurance companies to put in their portfolio. And then I broke it down to kind of what they're looking at. Fannie Mae requires a 680 credit score. Now you're saying, how does an entity have a credit score? This would be for a high, you know, high income person. You're not probably having a FICO score with a corporation or a limited partnership. You're looking at DSCR, which is debt service coverage of 125, and I'm going to go through that with you in the next few slides. You need an occupancy rate on your units of at least 85%, and you need to have liquidity of 9 months, which means 9 months of payments in an account somewhere. They want a reserve. Freddie Mac's a little bit different. Their scores are lower. The debt service is the same. They want a 90% occupancy rate. That means 90% of your units are rented. They also want a 9-month reserve. And the last one is FHA. FHA probably has some lower income rental type caveats to it. But again, they got a little bit lower FICO score. They'll go down to 1.15 debt service coverage, but they do want 95% with a 9-month reserve. It looks there, a lot of these complex 10 million and higher, you can get a 40-year mortgage on the FHA portion, which they look at, and it's 80% loan to value, loan to cost. Bank balance sheet type loans going to be more your community banks, maybe some of the larger banks. So they basically make their own rules based on what they're looking for. So on these, it's the financial institutions. It's based on their balance sheets. They're not backed by the federal government. Now they may have their savings and their deposits insured through the FDIC, but they're not backed. These are not guaranteed by the federal government. So they're going to sit on the bank books, basically. They make up their rules, whatever they see fit based on their lending practices. So they come up with their own set of guidelines and basically do it that way. These loans typically are from $1 million and above. some of the community banks and some of the other smaller banks, they'll usually go down to 500,000, and you can kind of get some that are even lower than that. So it just depends on what they're doing, but they like to see $1 million. They like to see at least 25% down, and the rates are somewhere between 4 and 5.5%. Closing costs are anywhere from 2 to 3%, and there are some prepayment penalties on these loans. Some do have them, some don't, and they would be a step down. By step down, it means, you know, year 1 you may have a 5% penalty. Year 2 you may have a 4. So it decreases the longer you keep the loan on the books. These are looking at minimum credit scores of 650 and debt service coverage ratios of 125. They like to see the 90% occupancy as well. What will help you on these, and what most community banks, are you a customer? Do you have money on deposit with them? They can then adjust some of their rules and requirements based on that, or they may require you, in order to get the loan, to put some money on deposit and have some accounts with them. And then there's also what we call, it's not on the slide, Carmen, go back one slide, I think, short-term apartment financing. That is the deal where it's more like a bridge loan. It's a little more expensive, a little more down payments for someone that just needs the money pretty quickly. You're looking at minimum loan amount of $2 million, 70% loan to values. Rates are usually between 6 and 10%. These are not hard money loans. They're just kind of a step south of that. It'll probably cost you 2 to 3 points, and the loan term is anywhere from 12 to 36 months. Again, on those, they could do some personal guarantees, or they may not. It just depends on each individual lender and kind of what they're looking for. If you go to the example, I did kind of a case study on something that recently closed that Carmen had put together. What you're going to do is, when you get it as a realtor or whatever, you're going to probably want to see the income and expense report. You want to look at how much they're renting all the units for, kind of the breakdown and what your expenses are. I'll wait for Carmen, see if you can throw that up there.
Can you see it?
No. One before.
The case study?
If you can. Should be the, it should be the slide before that. Should be the one from your Harvard income and expense.
Mm-hmm. Let me bring that up.
May not have it. Okay. Anyway, it's going to break it. It's going to break it down to, you got a gross income basically of units. And the example that we had was, this was on a 9-plex. And Carmen, you can go to that, the case study deal, the other one that you had up, and I can kind of walk through it. So, and then you look at all the expenses on an annualized basis for the units, and then it gives you obviously gross, net, gross expense, and then your net. Hang on, she's getting there. There we go. On this particular 9-plex, they had an annual income of $68,400. Their expenses, which were taxes, insurance, water, sewer, garbage, insurance, any repairs, those sorts of things. You're going to get this on a income and expense thing for the last year from the apartment management team or whatever. And this one, it was $27,035 was the expenses for the year. So net operating income debt service was $41,365. So basically what you're looking for is, as you saw in my examples, what the banks are looking for is, they have a debt service coverage, okay, of 125. You take that net operating income of $41,365 and divide it by 125, and that gives you $33,092 of income to service the debt. What a debt service ratio or debt service income ratio is at the end of your gross income minus expenses. For every dollar of net operating income, you need to have $1.25 to service $1 worth of debt, is basically what it boils down to. So we had on this particular example of 33,000 roughly. The sales price on this was 640,000. The bank wanted 25% down, so it means a little $480,000. I just plugged in some rates, typical, because this is a small, you probably be based on units, a little higher rate. So it's a 5.5 rate. It's a 25-year amortization due in 10. So it means that the rate is fixed for 10 years. The monthly payment on that is $29.34 and change, okay, which basically breaks down to about $35,000 to $200. Well, if you look at this, the actual debt service on this was, you take that net and you divide it by what the payment is really 117. So it's a little bit under the 125. So what might happen is the lender may say, we need to reduce the loan amount 480. It may need to be 450, or it may need to be 4.25, and reduce it down. Or they may say, we'll give you the 480, but we want you to put 50, 60, 100,000 in the bank. So that's kind of how you figure it out, to do quick calculations to see kind of when you are looking at maybe listing a property or being involved in purchasing. You want to do the quick cash flow to see what the cash flow is on it, basically. And I know it's kind of fast, and if I've gone too fast, don't hesitate to speak up and ask questions anytime, because sometimes it's obvious to me, but it's not obvious to you guys just due to the fast talking. You know, because I am a lender, so we are fast talkers. So if you go to the next slide, what you need in order to, what your clients or what you are going to need as an investor, I put in a checklist of all the information that you're going to need to require it. And a lot of people don't realize it's a little more complicated than just regular borrowing. So if you can throw that slide up, Carmen, in regards to the multifamily and commercial, and this is kind of interchangeable between commercial property and apartments. So they do want similar information. So if you can get this, it sure will make the process go quicker, and it'll help you analyze and understand what you're looking at, what you're wanting to buy, and also what the lender's going to want.
And I'll send these to everyone in case you find them helpful. Good checklist to have.
Right. First stuff is basically they're going to want a current rent roll. They want to know if their units, are they subsidized Section 8, or are they controlled? Is there no rent increases, basically, capped out? They're going to want to know what that is. The number of units, basically what the units are. Are they 2-bedroom, 1-bath? Are they 3 and 2? What the combination is for the whole complex. You're going to want a complete income and expense report, which obviously your expenses is going to want to know your annual taxes, your insurance, sewer, water, fuel, electricity, maintenance, and any repairs. The rent roll is going to give you the income. The expense is going to give you the expenses, so you hopefully have that, so you can basically look at what your net operating income is. Summary of all the commercial leases, and that would be individual on all the units too. So they'll want to see those, see what they are and what they look like. A complete detailed physical description, including square footage of the whole properties and units and those sorts of things. If you're acquiring it, please obviously provide the purchase contract. Photos, they'd like to see 5 photos. You may want to show them an individual photo of each unit and then the overall complex, just street view, kind of what it looks like, so they get a good idea what they're looking at without actually physically having to go there and do it right away. At least then what they can do with this information is kind of give you an idea, well, this is what it looks like we can lend to you, this is what the rates are, but they will end up doing a physical inspection and obviously getting an appraisal. If you have a site plan, they'll want that, or even drawings. If you've got the architectural plans, somehow they like to see that type of thing. If this is a refinance or whatever, if you're refinancing your property, they're going to want to know and see the who the current lender is, what the rate is, what the payment is, when the maturity is, all those sorts of things, and also if there's a prepayment involved. If it is a current business, this would be more for commercial financing, commercial office space, whatever. They'll want a business financial. They'll want a business license. They'll also, if for personal financial statements as well. They'll like 3 years, and it sounds like a lot, but they do want at a minimum the last 3 years for both business and personal on the tax returns. Because on some of the smaller projects, a lot of times of that. Down at the bottom, I just basically put in kind of what they look at as far as when you break it up. It's broken up into 1 to 4, which is, you can go to any mortgage guide to do the 1 to 4s, but a lot of the banks and community banks and do the 5 to 19. They'll do some 20 and more, but a lot of the 20 or more, again, are going to go with the big boys, Fannie, Freddie, FHA, large insurance companies, large REITs, those sorts of things. That who's going to be the end user or the end buyer of those deals. And those are pretty sophisticated. So I also threw in kind of a, is there any questions in regards to anything I've shown you or said?
Doug, what do you do when people do not want to show their schedules or their information?
Don't make them alone.
Yeah, well, what makes it tough is you're probably not going to get a loan. That's the problem. And you'll see the 5 to 20, 5 to 19 units are usually a little sophisticated, more individuals buying them rather than sophisticated. So it may want to provide it. A lot of times, if they're looking to purchase some units, the existing property manager owner don't usually like to provide their income and expense reports and their rent rolls and things like that. But it is going to be a requirement for financing. So it is an important thing. It does make the process go quicker, and it does let you know what you can and can't do, because it isn't just a straight I'm buying the units for $100,000 and 75%. I need 25,000 down. That's not how it works. They're looking at down payment. They're looking at the borrower. They're looking at the units. They're looking at the gross rents. They're looking at the expenses. They're looking at the net, and then they got to see if it can service the debt. And sometimes there's a lot of expenses. There's been a lot of repairs. The units don't show that it's been that it can service the new debt, but because they've done some repairs or remodeling on it and upgraded the units, and then the renters are raising the rents as you're putting new renters in, then you can, there's a process so that you'd be able to borrow more money based on that, because the work's already been done. But that's what the banks are pretty much looking at. It makes it very difficult if they don't want to. Yeah.
Doug, in regards to commercial loans, I'd like to expand it just a little bit in saying that our commercial business includes more than apartment houses, as we all know.
Right.
I was in charge of a commercial division for a bank out of San Francisco, and I had an application that came in on a very well-known restaurant in Fresno. And I'm certain it was very, very profitable. And this bank was a small bank, and before I made or allowed any commercial loans made anywhere in 3 states, I had a place to unload it. You probably have the same type environment. You already know where that loan is going before the docs are signed. And if you can't unload it, you can't make the loan. And then on this particular restaurant, like Doug was talking about, location, or as I was talking about location, almost everyone I talked to that I had a lending relationship, I said, by the way, this is a restaurant in Fresno. And they said, where? Fresno, Wisconsin? Or what are you talking about? I could not get a takeout for that loan. So basically what I'm saying, when you talk about discrimination, don't put discrimination in the same tone as commercial that you do in residential. Just not there. Just not there.
I think on commercial, there's a
That's correct.
Oh, go ahead, Doug.
No, I was going to say that's correct, Tom. And there's certain lenders, and Roger is too. You know, there's some lenders that are hotels. There's certain lenders that really like gas stations. There's certain lenders that like medical office complexes, and then there's guys that like strip malls and malls. So it's where your lender or your broker or whoever, they kind of need to know who's doing what out there in the world, because it's not one size or one thing fits all. Walk in, because a lot of times you'll walk in with a gas station or whatever, and most of those small banks and stuff aren't going to touch that kind of thing. So there's some specialty lending groups that do these things. So it helps to know where to take it and go from there. Because like Tom said, it's like, hey, you know, there's guys that just do restaurants and are really good at it. So and they like it and they understand it. And that's part of the problem is a lot of banks and lending institutions. You know, you've got people in there that may not understand them. They're new to the industry. They're new to whatever, and it's, you know, ag lending is the same way. You know, there's expertise in those areas, and there's certain ones that like grapes, and there's certain ones that like almonds, and you know, it's just how the world works. So it's knowing it. And as Tom said, this is commercial. This is not residential. This is not a consumer-driven or consumer required disclosures and things like that. This is people that are in business as investors, and they should be a little more savvy. So it's you know, buyer beware, and you know, you're kind of on your own, and you need to search.
Well, you know, Doug, too, and I'm not trying to get into Roger's business, my very dear friend, but in any event, one of the biggest competitors in the hotel industry, in particular in areas that are not necessarily class A or B hotels, is the state of California.
Yep.
The state of California are buying up, in fact, they're buying up one on Blackstone right now, already have. They're going to turn it into a homeless shelter. It's been there since I can remember. So you've got now competition from the state of California in the hotel business to provide homes for the homeless.
Yeah, Roger was on. He had to go to a meeting. He texted, but he did mention he was into, I don't know how many millions right now with the housing authority to purchase properties, and probably to do the same, right?
That's the same thing. Yeah.
Any other questions? Feel free to unmute yourself. Another thing I noticed, Doug, is there more of an emphasis on the individual getting the loan on commercial than the actual property? I see a little weight there on the investors.
Yeah, it just depends. It depends on the transaction and the type of transaction. And again, it has to do with you're probably, as a lender, you're looking at the security, you're looking at the property to pay the loan. But then they're going to look at a secondary source, and that is the personal guarantee of the person that's borrowing the money, or the entity borrowing the money. So property one, people two, or the person is second. So they're going to look at that. Medical office, usually it's, you know, usually the lease is to the medical practice or whatever, and the doctor may own the building and lease it to his practice. He owns it individually, and that's kind of how it works. But they'll look at him as far as making the personal guarantee on the property, or looking at him back up. That's why when you look at the checklist, there's personal returns and personal financial statements, and there's also business on both. So, but it is looked at property more so, and obviously the larger the loan amount, you're looking at the asset or the security of the property. And so on the big commercial buildings or big shopping centers or whatever, you're looking at that to generate the income to pay it off. And then if it's recourse, which means that's personally guaranteed, or the entity is guaranteeing the repayment secondarily, rather than non-recourse. So they're looking at the second stage. Non-recourse means that, as you saw in the first slide, they'll want to see the commercial buildings totally leased, or leased up to 90%, 95%, like 95% on the units. So they know that this thing's rented up and it's running, it's a machine, it can make the payments, because we're not relying on any individuals on the backside to come in. And if it defaults, we'll take the units and foreclose and move on and sell it to somebody else who can run it. So,
Hey, Doug, are your overlays pretty similar to what else is out there, do you think?
Yes.
Okay.
Yeah.
And I really like that sign.
We go all.
Go ahead.
No, you go ahead.
I was going to say, I like that sign over your right shoulder too.
Yeah. You mean my home office / extra bedroom?
Yep.
Yeah. So, and then I also, and Carmen will forward to you, I put in a economic outlook for multifamily and commercial for you to peruse through on your own. And if you have any questions on anything I sent, more than anything, give me a call and I can explain it, like I said. And I'm sorry it's not a beautiful PowerPoint, but we wanted to talk about this today. And so next time maybe we can go in more depth or whatever, or when we start to meet in person, can put something together. But it does help you to help at least know what you need to gather and what you're looking for when your guys are trying to not only individually buy investment property, but your clients, to help you with your clients as well, because this is what's going to be expected to provide. So in the particular one that we used as a case study or whatever, didn't fit into, because I looked at it banking wise, and because they had a lot of expenses and didn't get all the information that was needed from the seller and things like that. It looked like we were going to come in with a smaller loan, and the actual buyer was able to put together something where you didn't have to put as much. I think he ended up doing 20% down or 25% down, and to close the deal. But I think he went through either the existing lender and or his own bank where he had money on deposit, and they were able to put it together, pretty quickly, because they had all his information and everything. So, but if you look at this economic outlook, it's pretty interesting. It's pretty up to date because it does talk about COVID and what's happening in the commercial market. Is being affected more than the rental market. But again, nobody really knows where we're kind of heading. We're hoping we're heading back to a more normal way of living. If we ever get back to normal, that's remains to be seen. But it will tell you kind of where we're at and what's going on. And this is kind of a nationwide report, so it may not have a lot of details or information for you here locally. But one thing you can know is Fresno's rental market and investment market on housing is we have some of the highest rents in the United States. So it's a hot market, and people are looking to get into this market, and expect that to continue, into the years to come, at least for the next couple of years. But thank you for allowing me to speak. I appreciate it. Hopefully you learned something, and if not, I'll try better next time.
Yeah, if you need questions, feel free to unmute yourselves. Also, Doug, on these types of loans, is it common to see maybe like a 30-year loan with a fixed first 5 years, then changes year 5, year 10?
Yes, all the loans are. there are no 30-year fixed rate loans unless you are doing the Fannie Freddie FHA, and those are usually really large loans. Like I said, those are the ones they want to keep on the books for the term of the loan, and they're fixed for that time period. Anything after that, they're all anywhere. You may find some 30-year amortizations, but they may have 5-year calls. By that, it means that the rates, it's fixed for 5 years and they adjust a rate after 5 years. But those usually don't go out for 30 years. You may have adjustments every 5 years. You may have them adjusted every 10 years. And they may have, at the end of those periods, the bank decides not to continue. They may call, at the point you need to refinance it with somebody else. So they don't automatically renew it. You got to requalify every single time, and every single time there's fees and everything again. So you may get like a 30 due in 5 where they get an adjustment, but you may have a 10-year call on it. You've got one renewal, and then at the end of 10 years, you need to refinance or pay them off or reapply again. But there's no fixed rate 30-year type stuff unless you're doing the huge commercial stuff or huge apartment complexes.
And John, did you have a question? You're still muted, John.
I didn't have a question, no.
No, John Thor. Sorry, John Sweeney. Maybe turn up your volume, John, because you are unmuted. We still can't hear you.
Perhaps John can make us pictures or use sign language.
You can also type in, well, I know he had a physical therapy appointment this morning at 8:30, so I don't know how his arms are doing. Yeah, I don't know.
Anybody a lip reader?
No. Go ahead.
I do have a question though, Carmen, maybe while we wait for John to
Okay, go ahead.
type it in the chat. I was just wondering, is there a loan product that would be a single loan that can be loaned against for 2 properties? So for example, I have a property that has a large amount of equity in there, and I also want to buy an apartment, and I like to utilize some of that equity, but without having to do a refi cash out. Is there a possibility to do kind of a loan, a larger loan, or I don't know what the right term is, but a loan that would encompass both properties so that I could tap into kind of that equity?
Yes. Yeah. And it depends on your lender, where you might go. But yes, what you would do is you would do one loan, you'd have 2 deeds of trust, and you collateralize both properties. By that, it means they're both on the loan, they're both security. So like what you're trying to do, you may own one free and clear, which is all your equity. You may be purchasing another property, so you don't need to come in with a down payment or anything because it's already included in this other property that you own free and clear. And so they'll appraise and analyze both properties. But yeah, you can do that in the deal. The only drawback on that is if down the road you wanted to sell or do something to that other property, it's re-looked at, and you have to, it would have to qualify. So the property that's going to stay on the loan would have to qualify, have the equity in it or whatever in order to release that other property, be sold or refinanced or whatever you want to do. But yeah, you could do it, and we've done it all the time because a lot of people that they own free and clear, they just don't have the cash. They're land poor, as they say, but you've got equity and it makes it all work. So yeah, you can do that.
Thank you. Thank you.
And
Is
Doug,
there a term or a name for that type of loan, or is it just a
No, it's
strategy?
just a commercial loan that you will basically be putting up two properties, and then just the key word is cross collateralization. They're both
Okay.
collateralized, both properties, so it's a cross collateralization. It's a mouthful, but
Got it.
okay.
Thank you.
You bet.
any other questions? Yeah, I think we lost, your hand is still up, Mr. President Don Scordino.
I meant to put it down a long time ago. Sorry.
Oh, John, and tell us who's on your radio show this weekend.
All right. We've got a special guest star, Roger Story. And since I don't know a whole lot about hotels, motels, and the commercial, all those intelligent questions I'm going to be asking are really not so intelligent on my part. I'm really going to try to learn. So I think it'll be a good show full of good information and fresh information to me. Can I also tell about some upcoming events at FAR?
Yes, please.
Okay, so I made a pitch to our board of directors yesterday, and it was approved. And here's what I'm asking to do is I want to really have a September awakening for the Fresno Association of Realtors. You know, we've kind of been put on the back burner because of the pandemic. So here's what we're doing. It's 4 different things. First of all, we are doing we're co-sponsoring with ABC 30 a build of 2 homes for veterans through the Habitat for Humanity. And what we're going to be doing is asking for contributions from the community to this fund for the Habitat for Humanity. We're trying to raise $70,000. If we can do that, we'll build 2 homes in Clovis, because the city of Clovis has donated a couple of properties on Sunnyside and Bullard. So you're going to see a lot of that on channel. If you watch channel 30, you'll see a lot of that. The next thing we're going to be doing is an essay contest for children, and we're going to have a downloadable, fillable form that children can fill out. There will be 3 different age groups, or not age, but grade groups. And it's just going to be an essay contest. And we got $1,200 set aside for prizes for the children. That's something that our members, we're going to ask our members to distribute those. So maybe take that form that you'll get through FAR and send it to your clientele. And if one of your clients is a school teacher, even better, they can have the whole class do it. These kids are sitting at home having to learn from home, and we're just going to give them a little more homework. That's all. There will be and the question that they have to answer is what I like about my home the most. So we're trying to build pride in children of their home. It has nothing to do with home ownership, renting, or owning. It's where you live, and be proud of it. Because they don't get to go to school much either, we have a bonus question, and that is what I like most about my school. The third thing we're going to do is participate in the community food bank, fundraiser, where all funds are being matched by Gar Bennett, and they're having a big event on September 25th, and that will we're just trying to raise a lot of money. That one there, your association is actually going to make a cash contribution to them. And of course, any of our members that want to contribute also may do so. The fourth thing we're going to do is, we haven't had any real lunches, mixers, or anything like that. So we're going to have a virtual concert. And everybody can tune in on a particular night. We'll have a live band, kind of live. But in between the sessions for the band, we're going to be doing acknowledgments of the different committees and what they've done, and also our events during September. So it'll be a September Fest in October. I think that's the good name for it. I did have a band lined up, and then they came back and 3 of their 5 people said, no, they don't want to do it. So they feel like they don't want to do it virtually. They feel like they're an in-person band. So I'm not going to let a little thing like that stop us.
Just get out your guitar, Don.
Yeah, I can sing. Actually, I can't. That's it. And hey, thanks to everybody for being participating members of our association. And I hope that by the end of the year, we all say that, wow, our association got stronger, not weaker, because of this pandemic.
Yes, and these events are they're wonderful events that are creative. Not only engage us as realtors, but families and children. I love that in the community as well. So thank you for all of those things that you guys put together. Great.
Sure.
And thank you all for being here.
The way that I pitched it to the board of directors is I had all these ideas floating through my mind. So to make me have to do it, I went out and I made an investment. I spent 79 cents on a composition book, went to a park, and I wrote it all out. And because I had made that, by investing that much money, it made me have to do it. And so I took that composition book to the board and said, all right, this is what we're going to do.
You know what I think it was writing down your goal. And I think that's something we all need to do more of.
For most people, that's true. For me, it was spending 79 cents. That made me have to do it.
Anything else, Tom, before we go?
Hey, Carmen?
Yes, sir.
That's okay. Go ahead.
Next
Whomever
week,
that.
maybe, okay, sorry, Tom.
No.
Next week, maybe we should talk about, because what we're starting to see out in the field, people that have mortgages or rental properties that have opted to do the COVID postponement of payments, and what effect that is having on them purchasing new homes, refinancing homes, buying rentals, those sorts of things, because it's being told one thing, that it's all okay, it doesn't affect your credit, it doesn't affect this or that, but it does cause a problem with future financing in the short term. So and maybe talk about that, because I don't think most people know what's going on in regards to that, because they're told, yeah, it's okay, you don't need to make payments. On a rental unit, there's the renters are not, they're not required to make payments. So I just COVID my deal. Well, guess what? Until it's brought current and until certain things happen, you're kind of frozen out of getting any financing. So that needs to probably be brought to people's attention so they know what's going on, because we've run across a couple where people tried to buy things and they're in COVID forbearance and they can't buy anything, and can't buy anything for possibly up to 6 months.
Good idea. Go ahead, Tom.
Carmen, do you want to get involved or at all in our conversation from yesterday? Or just, first of all, I congratulate you on your response. Do you want to let that ride?
Yes.
Totally.
Let's not discuss that. Yeah.
Okay. Thank you, Carmen.
Thank you. Okay, guys, thank you all for being here. Appreciate seeing your faces out there. makes it positive for us to, you know, keep on going in our business and feel a little bit more normal, at least every Friday morning. And Dawn will listen to you from 9 to 10, right? 9 to 10. Okay. We'll see you guys. Thank you for being here.
Thank
All
you,
right, thank you.
Carmen. Thanks, guys.